All right, what's that? Okay, you missed the first class. Okay, I'll get the videos out to you on the group. All right, so let's get started with this. So now, a bit of a background about how concerning this class, right? So we talk about the fact that when you come into the market and you want to trade, the first thing you want to identify is the trend. All right. Now I see someone raising their hands. Please just hold on. When we're done with the class, there'll be time for you to ask questions and I'll answer. Right? Please just hold on. So the first thing you want to do when you come into a class, when you come into the market, is to identify the trend, right? So when you identify the trend, you want to find out, is it an uptrend? Is it a downtrend? Or is it a sideways trend, otherwise known as a range? That's the first thing you want to identify, right? So when you have identified that pattern, you've known is an uptrend or is a downtrend or is a sideways trend, then you know what positions you should be taking. If you identified an uptrend, you know that what you're looking for mostly in an uptrend is a buy trade. You're looking mostly for buy trades in an uptrend. You're looking for sell trades mostly in a downtrend, and then in a consolidation, a sideways trend is also known as a range. It's also known as a consolidation, right? Now, when you are in a consolidation, you are in a range. That may not be the best time to trade. You might have to wait for a breakout of that trend, breakout of that consolidation or of that range. When there's a breakout to the upside or to the downside, then you can continue to trade. You can then trade. The breaks out to the upside, then you're looking for buy trades. The breaks out to the downside, then you're looking for sell trades, right? So these are the three types of trends. That's the first thing you look for when you come into the market, right? So the next thing is, after you have identified your trends, now you are looking for support and resistance structures. You start to look into the market structure. You start to look into the market structure of the chart. What is the market structure looking like? What is the support and resistance structures? How are they basically laid out, right? So that's where you are going to be looking for entries, because now we said that when you get into a trade, when you get into the market, the first thing you're looking for is a trend. And then when you see a buy trend for an uptrend, for instance, you want to look for buy trades, right? So, but where do you get into these buy trades? You want to look for support and resistance structures that are being formed in the market, right? So those are the points where you'll be looking for trade opportunities. You want to then buy from a support and sell from a resistance, depending on the trend. The reason we follow the trend is because we are following the money flow. The trend is the money flow of the market. The trend is the money flow of the market. So basically, money flows in the direction of the trend. That's why you are always told, that's why we're always told as traders that the trend is your friend. You don't have enough money to trade against the trend. As a retail trader, you don't have enough money to trade against the trend. So you want to identify the trend and then go with the trend, right? But after you identify the trend, you want to now follow and look for structures where you can take your trades. So this is where these candle patterns come in. By the time you have identified your resistance, you have identified your support, you know your supply and your demand zones, you've identified those, right? Now, if you don't understand a lot of these things I'm saying in this class, we've had classes already for this, and we're still going to have classes for these things I'm saying in the future. But then you can also indicate in the group. I'll drop a lot of the trainings we've had in the group so that you can take advantage of that. But in the future, we're still going to have a lot of these classes all over again, right? So when you have identified those, then now you're looking for what is the candlestick pattern that's forming around support and resistances to give you confidence when you're entering a trade, right? So when you're looking to enter a trade, there's what we call confluence, right? There's what we call confirmation, confluence. You are looking for how many signs, how many signals, how many things around the market is telling me to buy. How many patterns am I seeing? How many signals am I seeing around this buy trade that's telling me to buy? How many, if you get a if you get a very solid buy trade, a very solid support to buy from in an uptrend, right? You know that that's probably a very good trade because you're already on an uptrend. Now you are seeing a support that is very good for you to buy from in an uptrend. That is an example of what you call a confirmation, right? A confluence. So there are lots of confluences. So what we are looking at here with candlesticks is we are looking for candlestick patterns that will basically tell us what to do, right? So when you see a candlestick pattern and this candlestick pattern is telling you to buy, and then you are in a support level, you're at a support level in the market, and you are seeing a candlestick pattern that's telling you to buy, that is what you call a confluence. That's a confirmation, right? So that's already, you're already expecting to buy from a support. Now you are seeing a candlestick pattern telling you to buy. That's a double confirmation. So that's likely to be a very good trade, right? So those are the things we look for in the market. And that's the reason why we focus, we're paying attention to candlestick patterns and then price action, because price action is basically candlestick formation, okay? Price action is basically candlestick formation. So when you study how the candles form, like I always say, every candle that forms in the market, be it 5 minutes, be it on the 5-minute chart, be it on the 15-minute chart, be it on the 1-hour chart, on the 4-hour chart, every single candle that forms basically gives us data that we can work with. It gives us information that we can use to make trades, that we can use to make trading decisions in the future. So every pattern you're seeing, every candle, if the candle is an impulse candle and is very large, it's telling us something. If the candle is very small, it's telling us something. If the candle wick is very long and the body is very small, it's telling us something, right? If it forms around the support, it's telling us something. If it's a doji, it's telling us something, right? So that will now help us to determine what we will do next on our next trade. Maybe you don't make a trade, you don't make decisions based on one single candle, but it has to play into a bigger picture, right? For example, when you see a candle formation, a price action formation around the support, that tells you, and you're already expecting to buy around the support, right? Now you see a candle formation around the support that basically portrays your decision, the decision you're already making to buy. So that's double confirmation for you. So you're not making a decision based on just one single thing. Oh, is a support, let me buy, or is a resistance, let me sell, right? So you're not looking at that, you're looking at multiple things in order for you to be able to enter a very high probability trade. A very high, so that's what we're looking to do, get into very high probability trades. No trade is guaranteed to give you a profit, right? But then there are things you put together to give you a high probability trade. And this is one of them. All right. So we've looked at a couple of patterns before, several patterns. We looked at the engulfing patterns. We looked at several other patterns, right, in our previous video. So I'll post that later on. So those who were not in that class can then take advantage of that. So in this class today, we're going to be looking at a few more patterns. Now, this book I have here is called the Candlestick Bible. There are so many different patterns inside, candlestick patterns that you can learn and then master in the market. So when you see them, you know exactly what you should be doing, right? Not all of them are important. So we are only going to highlight the ones I consider the most important ones, right? Like I said, we talked about a few of them in our previous videos and in the previous class. Now we are going to talk about a few more in this current class, right? Okay. So the first one we are talking about now is the hammer, is also known as a pin bar. So basically, the hammer is a bullish, is a candle that depicts a bullish pattern. So a hammer is a candlestick that is created when a high and a close are roughly at the same price. Now, they are not at the same price. So the candle looks like this. Okay, so if you can see my screen, this is what the candle looks like, right? So a hammer is a candlestick that depicts a bullish pattern. Is a bullish price action. It depicts bullish price action. Okay, so let me do a little anatomy of this candle to help you understand the formation of this candle and why it's a bullish candle, right? So now, when you look at every candle that forms, for every candle you see forming in the market, there is that every candle you see forming in the market forms within a particular period of time, within a particular time frame, right? So we have a monthly candlestick, we have weekly, we have daily, we have 4 hour, we have 30 minutes, we have 45 minutes, right? If you're using TradingView, you have 2 hours, 3 hours, you know, but if you're on MT4, you have 5 minutes, you have 1 minute. So every candlestick you see on the chart, depending on the time frame you are on, is formed within that particular time frame. So, but what you have to understand is that for every candle that is forming, the way the candle eventually closes tells you about what happened, tells you what happened within that period of time. Let's say 5 minutes, right? Let's say a space of 5 minutes and you see a candle form. What happened during that period of time? It plays into exactly how the candle eventually ended. Because once one candle closes, another one opens. So let's look at this candle now, for example. So within a particular time frame, there are bulls and bears. There are bulls and bears, which means there is buy volume and there's sell volume within that time frame. There's buy volume, there's sell volume within that time frame. Okay, so now the way the candle closes tells you who overshadowed who. Did the buyers overshadow the sellers? Did the sellers overshadow the buyers? The formation, the way the candle closed will give you an idea as to what is likely playing out in the market. When you see a pattern, a candle formation, a price action formation like this, that shows you that the buyers overshadow the sellers, it tells you that there is bullish momentum coming to the market. Bullish momentum is coming into the market at that time. And then also when this kind of candle forms around a support structure, a support zone, this tells you that a lot of volume, a lot of buy volume is coming in at that time. A lot of buy volume is coming at that time. So let's do a little, let's understand this candle. So look at this candle. The wick of this candle, you can see how long it is. Now we're going to take this candle, this white here, as it could be white for your chart, it could be green, whichever one that whichever one you think you like to use on your chart. Some people like to use a white candle for bullish candle and use black for bearish. Some like to use green and red, right? So in this case, we're using white for a bullish candle, okay? So now look at this candle, look at the wick of this candle. The wick is this shadow that's very long, right? It's called the wick, it's also called the shadow, all right? So this book, I will share this book in the group after this class for those who don't have it already. I shared it the last time we had this class, we had the first class, I shared it. I'll share it again for the new people that are just coming on this, coming into the group right now. All right, so look at this candle, okay? Explaining this candle will help you understand the other patterns, the other candlestick patterns we're going to look at in this class. So look at this candle, you see the wick is very long. Now, what this is telling you is that when price opened at this top, you see where it says the opening price? That's the opening price. That's where the candle opened. When it opened, what happened was that the sellers sell volume, a lot of sell volume came into the market initially. A lot of sell volume came into the market initially, which means there was a lot of there was a lot of sellers in the market at that time. So they pushed the market down, pushed price down all the way to this level from the open price. They entered the market, started selling, and pushed the price down. But somewhere around this bottom here, buyers began to take over, which means buy volume, a lot of buy volume started coming into the market from this area. Okay, so buy volume came in, overshadowed the sell volume, which means there was now more buy volume than sell volume. Picture this like a scale, guys. Picture this like a scale. Now, when you put down a scale, if there's nothing on both sides, it balances, right? But when you put something on one side, it begins to, on the left-hand side, for example, the left-hand side starts to go down while the right-hand side goes up, right? Now, if you now put more load on the right-hand side, what happens? The right-hand side starts to take over from the left-hand side. So it's a picture that is something related to what we are seeing here. So the sell volume came down first, then somewhere around this bottom, buy volume started coming in, and buy volume took out the entire sell volume, literally cleared out the entire sell volume, and then managed to push price into the positive territory within that time frame. Let's say this time was like 5 minutes, like we said before. Let's say this was 5 minutes. Then positive price, the buyers were able to push price into the positive territory within that period of time. So when you see this happen, it tells you that the buyers are now in charge. So now that they push price into positive territory here, what you are expecting next is price continuing to the upside, continuing to buy, continuing to the upside. That's what we are looking at, for price to continue to the upside, right? So that's what it is. This is what this tells you. This is the reason why this is a bullish candle. This is the reason why it's bullish, is a bullish price action, okay? So let's look at an example of where this played out, okay? So usually a bullish candle, a bullish price action like this, it's best when it happens somewhere around a support zone, a support structure, because you can see any kind of candle form along the chart, anywhere on the chart, anywhere on your chart right now, you can find any kind of candle. But the more valid ones, the more valid candles, the more valid hammer candles, yeah, we're on a hammer here. The more valid hammer candles are the ones that are formed around a support structure. The ones that are formed around a support structure. If there is no support there, it's not like you won't still see price push up, but you may not see price push up significantly. So you want to make sure, like I said earlier, before we got into this, I talked about confluence, right? I talked about confirmation. This is what we are doing here. This is confluence and confirmation right here. So we want to make sure we are already in a zone where we are expecting to buy. We're already at a zone where we are expecting to buy. Now, price action is giving us an extra confirmation. Price action is giving us extra confirmation, telling us, hey, this is a good time to buy. So this is why this is a pattern that you want to watch out for, especially around support structure. So when we say it's a bullish candle, we are saying that this is a candle that gives us an indication for a buy. It indicates to us that we should be buying. But then before you use this candle to buy, make sure that other things are in place, like you are in a support structure, you are in an uptrend, all of those things playing together, working together, right? Because everything we learn in the markets, guys, when it comes to analysis, everything we learn, we are meant to use them together. That's how we create confluence, the kind of confluence that gives us high probability trades, right? So we don't take them each one at a time. We don't take them separately. We don't take them in isolation. We try to make them work together because they work best together. Not everything, but a lot of it working together it's better than you taking one in isolation, right? So this is the reason why this is a bullish candle, and then you'll be looking to use this for a buy. So keep an eye on these, and you can go to your chart right now, not now, after the class, obviously. Then when you are done, you can go to your chart and look for support structures. Like I said, come into the chart. The first thing you do is identify a trend. Then you look for buyers. You look for structures, support and resistance structure. You mark out those things, and you start looking for candle patterns. So candle patterns will now tell you, okay, it's time to buy, it's time to sell, or don't buy or don't sell. So you can be at a support and you do not see any candle pattern that tells you, that gives you a confirmation that you should be buying. Because remember something, guys, price always does a couple of things when it gets to a structure. Let's take a support or a resistance structure now. When price gets to a support, price will either hold at a support, which means it will reverse, it will start to buy at a support, or price will break the support and continues downward. Price will either hold at the support or break the support. Okay, so that's what you have to keep in mind. So the confirmation that you will have that will give you the confidence to be buying at the support is not just because price is at the support. Price is as a support, yes, but we know that price will either reverse and start buying at the support, or it will break the support. So you want confirmation for your buy before you buy. That's why these candle patterns are so important. You see? So that's it. When you get to a support, you're looking for, hey, I'm looking for a pattern. What pattern is telling me that this thing is going to buy? Because I know it's also possible for you not to buy, even though we are at a support. Even though we're at a support, we know the market is full of ups and downs. It's full of support and resistance, support and resistance, support and resistance, new ones, old ones that were broken, new ones that were formed, like that, all over the market. So you're not going to just buy at a support because you see the support, you're like, oh, here is the place to buy. Yes, you buy at support, but you need confirmation from price action and a couple of other things to enable you buy. Excuse me. All right, so let's move on to the next one. Let's move on to the next one. The next one is a shooting star. Shooting star, right? Shooting star is the next one. Shooting star, a shooting star is basically a bearish price action pattern. It's a bearish candlestick pattern. Okay. Now, this is basically the opposite of a hammer. It's the opposite of a hammer. So this one is used for sell side in the market. Is used to enter sell trades in the market, right? So it's the same thing, but this is the opposite, right? You know, in the market, we either buy or sell. We're looking for either buy or sell signals, right? So now we've talked about the buy. Now the shooting star is a bearish pin bar, So it's bearish. So what you want to do is that you want to look at, as you're on the trade, you want to make sure when you use this more, you use this best when you are at a resistance. When you are in a resistance area and you see a shooting star formed, that gives you extra confirmation to enter that trade. That gives you extra confirmation to enter that trade, right? So a shooting star is a bearish price pattern. And so let's just do a little explanation of this pattern too, like we did for the first one. So now price open here. You see where it says opening price. That's where price opened. That's where this candle opened. So when this candle opened, you will notice that when it opened, price first of all moved upwards. That's what is shown with that wick, that long wick that you're seeing, or shadow. That long shadow you're seeing, that shadow was formed because price initially went above. Price initially bought. Price started buying initially. So when it bought, then at a point somewhere around this top here, sell volume entered the market. Sell volume began to enter the market and push price to the downside. Just like I explained earlier. So there was now more sell volume than buy volume. So sell volume took over the market and pushed price to the downside, and then eventually succeeded in making the price, the candle, end in a bearish formation. Gave it a final end as a bearish candle, right? So when this happens, what usually happens, what this gives you, the understanding that this gives you is that the bears are in the market. The bears are dominant right now. So what's likely to happen is that this candle, after you see a formation of this candle, the price is likely to drop to the downside. All right. Now, like I said, it is best for you can see any candle formation anywhere on the chart at any time, right? But the more valid patterns you're looking for are the ones that form around support and resistance structures. So when you see a shooting star, it should be around the resistance, right? Like I said, again, when you are at its resistance or support, when price gets to a resistance, price will do one of two things. Price will either hold at a resistance, which means it will reverse and start to sell, or it could break it and start to buy and continue buying. So it is candle patterns. It is these candle patterns. Please put off your camera. Thank you. All right. Put off your camera. So it is these candle patterns, guys, that tell you that price is about to drop. Price is about to come down, right? So you don't just sell at a resistance because it's a resistance, or price will come down to resistance. No, there's no guarantee that price will come down to resistance. If you don't see a candle pattern around the resistance that tells you to sell, you don't sell, because price could as well break that resistance without any hesitation. Price could break a resistance as though it's not there, right? Especially during news events. So what you want to do is you want to make sure that is a pattern, is a candlestick pattern, setting price action formation around your resistance to tell you to sell. So, and this is one of those very important candle patterns that can help you. We talked about some earlier, like the engulfing candle. The engulfing candle is another very, very important one that will show you to sell. Like a bearish engulfing, you see price make a very huge bearish engulfing around the support, around the resistance. That's telling you sell. That's giving you a sell pattern. You know, that's when you can then sell with confidence, because you already know that, okay, I'm at a resistance, I'm meant to be selling, right? But then now that you see this pattern, it gives you extra confirmation, like confluence, a confirmation that, okay, now I think I should be actually selling, because this candle pattern is telling me to sell, right? Great. So that is for the hammer, that's for shooting star rather. Okay, so let's go to another one. So another one is called the harami. Harami. So the harami is a bullish bearish pattern. So there's a bullish part of it, there's a bullish part of it, there's a bearish part of it, there's a bullish version of it, there's a bearish version of it, right? So this also, remember, every time, guys, you see when we talk about price action, and we're talking about bullish or bearish, most of the time, it is best that you follow what we said earlier. First of all, understand the trend when you come into the market. What is the trend? Second, then you want to look for buy and sell structures, support and resistance structures where you can buy and sell. Okay, there are many things. We talked about market structure. We had a class where we talked about market structure, trend identification. We've done all those classes, right? Where we show you how to identify a trend, several ways of identifying trends, right? So now, but when you have identified those and you now come to your support structures, support and resistance structures, that's when you now be looking for points of entry. And this is where these patterns, these candlestick patterns, this is where they come into play and help you really get confirmation for either a buy or a sell. Okay, so this one right now is a bullish harami. Okay, it's a bullish harami, and it's a Japanese. Most of these candlestick terms are basically they are Japanese terms, right? So the Japanese candlestick was invented by a Japanese trader many years ago. So a lot of these patterns, they are Japanese terms. Okay, we don't need to really know what they mean. What we just need to understand is the pattern. Okay, once we see this pattern, the goal for us is for us to be able to buy and sell, and then be able to know where to buy, where to sell, what are the confirmations that we need for a buy and a sell, and then so for us to be able to make profits. Okay, so this is a bullish harami. So usually around this bottom here, you see two candles. You see a mother candle and a small candle. So around this bottom here, you will usually see price will make a swift movement towards the resistance, a support in this case. Price will make a rapid movement towards the resistance, towards the support for a bullish harami. Price will make a massive sell towards a resistance. This bottom now would be that resistance. Price will come there rapidly and then stall from there. You would probably be thinking that price is likely to keep coming down, but then it stalls and then doesn't break out. It doesn't break, it stalls. Then after the next, once you're watching the next candle, you will see another candle form. You see a huge sell candle. Then you will now see a smaller bullish candle. So what's happening here right now is that buyers are taking it. It's like taking the baton. Buyers are taking the baton from the sellers. So there was a lot of huge volume here coming into the sell zone, into the buy zone. There was a lot of sell volume coming into the support right here. This huge candle, huge red candle, tells us a lot of sell volume came into the resistance, into the support here, right? But then the buyers were there with their orders ready to literally mop up the supply, mop up the sell volume. Buyers were there with their orders, their buy orders, ready to mop up all this sell volume that's coming in. Okay, so when they have soaked up that sell volume, you now see price starts to go up. Then it moves up a little bit first. When it moves up a little bit and you see this formation happen, this smaller candle, it tells you that price is likely taking off in the buy direction now. It's likely going to buy now. So that's why it's called a bullish harami. That's the reason why it's bullish. Now, these candlesticks, like I said, now the terms are Japanese, but you can easily take two candlesticks and analyze them the way we are doing right now. You can take two candlesticks and analyze what's going on. So what we're not just calling them bearish or bullish for nothing, or we cram them like that. No, we're not cramming them, right? They are not like A cannot be another thing. A has to be A, B has to be B, Z has to be Z. That's not what it is happening here. What we're actually doing here is that we are using the formation in the market, understanding how price is moving. We are using the formation in the market to basically understand the movement of price here. Using the volume in the market to understand what's going on, what is going on in this market right now, right? So that's why this is a bullish formation. It's a bullish formation. Usually, when after this small candle forms, you will see price take off in the up or to the upside and start buying, because the bulls are entering the market at that time. All right. So this other one is a harami, but this one is a bearish harami. Okay, so usually when you see a price will move massively, a buy candle will move massively towards a resistance zone, then it stalls when you get there. When it stalls when it gets there. So what's happening around that resistance zone right now is that there's a lot of sell orders. Sellers have come there and have placed a lot of sell orders there. So those sell orders are basically mopping up all that buy volume that's coming in. You see, that's why sometimes you look at certain charts, you see price hit a particular point and then reverse immediately. You'll be wondering, why is it reversing so fast? It reversed so fast because there was a lot of buy or sell orders there. These are pending orders, right? Because there's buy pending orders where you have buy limits, sell limits, buy limits. Then there are sell limits and all that. So these are orders that people place in the market and say, okay, when price gets to this point, price will trigger and then it starts to buy. Or if you sell limits, when price gets here, price is trigger and start to sell. So that's what usually happens when you see price just hit a particular zone and take off, because there's a lot of orders there that already entered. They're already waiting at that point. Once price gets there, it reverses immediately. So this is what happens here. You see buy volume, a lot of buy volume came into that support, that resistance zone, and then there was a lot of sell orders there, mopping it up. Now, if there were no sell orders there, the likelihood would be that price is going to continue to the upside. But in this case, there was a lot of sell orders there. A lot of sellers were ready with their money to sell at that point. We're ready with their money to sell at that point. So you will see that the sellers will mop up that buy volume that's coming in, mop it up. And then you now see after that candle, by the next candle, you see a small sell candle like this, a small bearish candle. It's telling you that the sellers are now taking charge. So you notice that price will start to come down massively like this. You see? So these patterns are things that you just study, and then you go back to your chart and then you look into them. You start to look for them. Look at this is an example right now. So you see massive candle gets there, a small candle formed, and then you see a huge engulfing candle, a huge bearish engulfing follows that, and then price just starts crashing from there. You see? So these are things that are practical, they are not theoretical, right? We're explaining it. Yes, that's theoretical explanation, but these are not theoretical things. They are happening in the market. When you pick your chart this weekend and you're studying and you're preparing for next week and you want to look at what's going on in the market, right? You want to be able to use these patterns, look for these patterns in the market, and you will see them there. You will see how they play out. You will see them there. You will see how they play out. Okay? That's for the Harami. So the next one we're going to look at is the, so let's go there. So tweezers. Tweezers, this one is so important too. Now, these tweezers are also called railroad. Now, it's like an antiquated term that's used for them, right? But it's also called railroad. And then you understand. I will explain a little bit around why they call these candle patterns railroad, right? So you see these two candle patterns. This is what you call the tweezer bottom. So there's tweezer top, there's tweezer bottom. Now the tweezer bottom is a bullish pattern. The tweezer bottom is a bullish pattern. So what the way it happens basically is the way it happens is that first of all you will see a certain bearish candle of a certain size, of a certain height. Then that bearish candle closes. It will now be followed by a bullish candle that is about the same size, about the same height as the previous sell candle. So the difference would be that one is a sell candle, one is a bearish candle, and the other one is a bullish candle. But they are about the same size, then they opened and closed almost around the same place. So this is what you call a tweezer bottom. And what usually happens is that after you see a tweezer bottom, candle starts to buy. The market starts to rise, starts to go up after you see a tweezer bottom. Okay, so just think about it like this. You see a sell volume, you see a bearish candle, then you see a bullish candle. A bullish candle comes after a bearish candle, that's a buy. That's a tweezer top, a tweezer bottom. That's a buy. A bullish candle comes after a bearish candle, that's a buy. Price starts going up. So the reason why they call them railroads is because they picture them as the two legs of a train, right? So usually they are the same. The two legs of a train are the same. When you're looking at a rail, the left-hand side and the right-hand side are usually the same, right? So they use it, I think they used it mostly they used it to remember this pattern very clearly. So when you look at them, when you line both of them together right now, what does it look like? It looks like a train track. Okay, that's why they call it railroad, right? It looks like a train track because they are the same. They have the same size. The difference is just that one is bearish and that one is bullish. Okay, so you can use that to remember this pattern. If you don't remember tweezer is so abstract to you, you can use railroad to remember this pattern. Okay, but remember, when you have a bullish candle following a bearish candle, and they have the same size or height, that is a bullish pattern, which means that price is going to buy, likely going to buy after that. You can go into your chart and study this. You see it happen like that. You will see it happen probably more than 80% of the time. You will see it will buy bullish 80% of the time, right? So these things, even though we are talking about theory, talking about them theoretically, they are not theory, they are practical. So I encourage you to go to your charts and begin to identify these patterns and begin to understand them, because that's how you're going to understand them better, by you going to the chart yourself to understand them. Go to your chart, go to your own chart, pick your chart and start to understand them. Like I said, I'll share this book in the group. You can go back again and then look for these patterns. Go to your chart and look for them, because that's how you're going to understand this. That's how you're going to master this. You will master it by practice. And the way you practice is look at these patterns right from the book, and then go into your chart and look for them and see how they play out. So when you go to your chart now, you look for a tweezer bottom. How did it play out on the chart? Right? That's what you want to check. Then you look for another one. You go from Euro USD, you check. You go to gold, you check. You go to USD JPY, you check. You go to whatever pair you want to check. Euro USD, you go there, check, look for these patterns and see how they played out. That will give you a deeper understanding of this, because you have to practice. Practice is the way you actually master the concept you are taught in trading. Practice is more than 80%, right? So you can learn and learn and learn from the best professional, but if you don't spend a lot of time practicing, at least an hour or two a day practicing these concepts, you may not get them very well, okay? So this is tweezer bottom. Now, the next one is the tweezer top. So the tweezer top is the opposite of that, all right? So think of the tweezer top as this. The tweezer top, tweezer bottom, the previous one, is a bearish candle followed by a bullish candle and is a buy pattern, right? Now, for tweezer top, the tweezer top is a bullish candle followed by a bearish candle. So tweezer top is a bullish candle followed by a bearish candle. And when you see that pattern, it's usually a bearish pattern. It's a bearish pattern, right? So when you the way it is that you see a bullish candle, followed by a bearish candle of about the same size or height. You see, so that is a bearish pattern, and usually you find that a price will sell. Price will usually drop from there. Market will become bearish once you see this pattern happen. So, like I said, again, take these patterns, go into the market, go into your chart this weekend, take 2 hours, 1 hour, 3 hours, depending on what time you have, and look for these patterns. That's the way you're going to master them. Look for these patterns and practice them. Try to understand them by practice. Look for them. When you do that, it starts to, get very, 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 get very deep rooted in your mind. You start to understand it at a deeper level, right? And then at a deeper level where you can actually use it for your trading, use it to profit from your trading. Okay. So these are the 4 patterns we are going to look at this night. Like I said, there are a few more patterns on this candlestick book, but these are the ones I consider to be the best patterns. You don't have to. There are some of them that are very many are complicated. You don't really need to know. You don't need to know all of them. You can go ahead and know all of them if you want to, but the most important ones are these ones I'm showing you right now. Right? So you can master these ones, use them on the chart. You don't have to. When it comes to trading, guys, one thing you have to understand, you don't need to know everything. You just need to know a few things very well by practice. When you know a few things very well, when those things happen in the market, you pull your trigger. When those things happen in the market, you pull your trigger and then you make your money. That's the way trading is done. Trading is not, I know everything. I know Fibonacci. I know Elliott Wave. I know this. I know Ichimoku, Kunkei. No. You don't have to know all of those things. What's important is which one of them have you mastered that you are using to make money in the market. There are lots of people who know all these things, and at the end of the day, they really don't know anything because they're not making money. If you're not making money trading, you don't know anything, right? Now, that's not a bad thing. You are just on that journey, but you don't, that's why you want guidance to help you to understand, to know better how you should do what you should do, by taking a few things and mastering them properly. Okay, so these are the 4 patterns we're going to go through. So I'll give some time for us to ask some questions.